Today, the favorable policies for the real estate industry have ultimately been executed. Lower interest rates, lower reserve requirements, lower rates on stock mortgages, and lower down payments for second homes. These four are being rolled out successively. Today, the central bank's governor announced 5 major benefits at a press conference by the State Council Information Office. The first is a policy shift towards lowering interest rates, which will decrease mortgage costs for those buying homes. This can boost our overall housing demand to some extent. It's crucial to focus on the policy's clear mention of adjusting both deposit and loan interest rates together, keeping a certain interest margin for banks. On one hand, we enjoy the cost savings from reduced mortgage loan interest rates. On the other hand, we must forego the interest earnings from our savings accounts. The second point is more significant, lowering deposit and loan interest rates. We've discussed this topic many times before, and this policy has finally been implemented. The policy sets a guideline to lower interest rates on deposits and loans, aiming to align existing loan rates with those of new loans, reducing them by about 0.5 percentage points. The meeting outlined our strategy for reducing existing loan interest rates. Previously, the high rates were mainly due to the combination of LPR and floating points. This meeting clarified that we will return to the interest rates of our newly issued loans, meaning that the interest rates on our existing loans will essentially be anchored to the trend of the LPR. The policy adjustment itself shows that it is absolutely not a one-time spatial adjustment, but rather a dynamic adjustment mechanism for future LPR or existing loan interest rate adjustments. It's important to note that during interest rate cuts, we benefit from cost savings. However, when we enter a rising rate phase, we will face increased mortgage costs. Everyone should note that the central bank's guidance is not a strict requirement for commercial banks. We need to see if they can fully comply. Our third benefit is the reduced down payment for second homes. Reducing the unified rate from 25% to 15% has a major impact on the industry, as the housing demand in our core cities is mainly driven by the need for improvements. This policy can effectively reduce the barriers for entering the market for improving housing demand and stimulate the ongoing release of that demand. The fourth boost is that the central bank raised support for housing loans to 100%. This helps troubled firms and ensures home deliveries. With the new loan intensity rising by 67%, local governments are experiencing less pressure in financing and pushing projects forward. However, everyone should focus on the fact that the central bank's overall allocation will shrink, as the original 60% allocation meant that 300 billion could leverage 500 billion in commercial bank funding. If we follow the full allocation principle, we can essentially only mobilize about 300 billion. The policy itself suggests that the current relending quota of 300 billion is still relatively ample. It can be seen indirectly that the pace of advancing the reloan for affordable housing is actually not fast. The fifth aspect is the impact on expectations. The financial conference consists of key meetings that greatly influence expectations and confidence, overshadowing the actual content. It shows us, the many home buyers, the government's strong support for economic development and real estate policies, enhancing our confidence in the industry and future economic growth. This meeting has delivered 5 key benefits to the industry. Each policy significantly affects the industry in its own way, but the most crucial impacts come from the combination of policies. For example, the down payment for a second home has dropped from 25% to 15%, greatly easing the home buying process, alongside reduced mortgage rates and lower costs for existing loans. Originally, the costs associated with mortgage loans have also declined, leading to a systematic reduction in the financial burden on home buyers. This represents a substantial positive impact on demand across the entire industry.